right. Well, thank you everyone for joining today's session entitled Edge Investment Landscapes. I'm your moderator today. My name is Jim Prismitzis. I'm the founder and CEO of the 5G Open Innovation Lab here in sunny Seattle. And I'm joined today by two panelists, Rob Bartlett, who is the Senior Managing Director for Guggenheim Securities, and Juan Muldoon, who is a partner at Energize Ventures. Before we jump into today's discussion, Rob, would you like to take a moment just to introduce yourself?
Sure. Thanks very much, Jim. So Rob Bartlett, I joined here about 2 years ago to found the West Coast office here in Menlo Park of Guggenheim. I came from Goldman Sachs, where I headed cybersecurity and infrastructure software.
Excellent. Thank you, Rob. And Juan?
Great. My name is Juan Muldoon, and I'm a founding partner at Energize Ventures. Just briefly on Energize, we're an investment firm focused on digital solutions for energy and industry, bringing software to help improve operational efficiency and drive sustainability to really industrial operations from Series A to IPO.
Awesome. Now, there's multiple paths we could take in today's conversation, but guys, let's start off a little bit about Edge as an industry, some of its myths and opportunities, and then we'll get into the investment landscape as well. Rob, question for you. There's a lot of chatter about, Edge. Is it really real? Are we there yet? Are there enough customers in the ecosystem that are, they're kind of bought into it? Some go as far as saying that Edge is sort of a bit of a mimic right now, and it's not really ready for prime time. I know you have a very clear perspective on where that is. Do you mind sharing that with us?
Sure, absolutely. I think that the biggest myth about Edge is that it's a myth. So I think there are cynics, just as there were when cloud adoption started. And actually, if you look at the early adoption of cloud and kind of mirror it 12 years later, so if you look at the pace of growth and where cloud started from around 2008, and you index that to where Edge is in 2020, the parallels are very much there. The drivers of it are simply there's not enough. You can't just pipe everything back into a data center, do all your compute, all your networking storage, and have that same pipe to do everything that needs to be done out there. Whether that's 5G, whether that's connected cars, whether it's frankly just compute, just the ability to have more touch points. There's more and more stuff we need to do. And that framework, that hub and spoke model, if you will, just won't work. It's for the data requirements going forward. Edge is the only way to do it, which brings all those questions to bear. So I think from a spend, from a CapEx perspective, where it's going to go, there's no question. I often refer to Edge actually as Cloud Wars 2.0, with 1.0 kind of be how we think of the public cloud today. But it's about a 12-year lag, and I think it has the potential to be every bit as big, or actually with hardware and everything else, bigger than cloud ultimately is as we think of public cloud.
Juan, in lieu of what Rob just said, and I wholeheartedly agree, there's a number of different players. I know Zedata is one of them, clearly. I'm curious to get your perspective as an investor, both intrigued with where this market opportunity is, but also actively investing in it. What are some of the key sectors or signals that you're looking at in this edge, broad edge investment landscape, and where are you starting to make your bets?
Sure. We've made our first investment in Edge in Zedata. We led the Series A several years ago now, 2018, I think it was. And so we've been, following it very, very closely since then. And I think there's a couple of different trends that have continued since then. Number one, the costs for both computing and communications obviously continue to go down. And I think the need for data analytics has continued to increase, especially for the industrial verticals where operations have really become more digital, and the analytics and the insights that are born from that have become much more critical. So we see Edge as a real enabling layer for the promise of analytics to bear any kind of fruit in really improving industrial and energy operations. I think that there was a huge wave of interest in 2018, 2019 with this sort of promise of the digital twin, where a lot of folks said, oh, well, you'll be able to basically manage everything through a digital twin and have a perfect view of every kind of operation. But in reality, that the industry wasn't quite ready. The enabling layers from just managing the data to managing those analytics just weren't there. The security implications hadn't even started to be talked about. And so we think that that's a much, much different environment today. We see that real industrial operations, especially in new markets like renewable energy, electrification of mobility, and other energy resources, they're being more connected and more distributed. And we see a huge importance for real-time data analytics, because when you're dealing with power, literally, power, electrons, operational impacts happen at the speed of light, right? And so
Yep.
we think it's critical to have some of that base layer infrastructure ready, the communications, the orchestration, the security, and the analytics. And on top of that, we talk to a lot of these operators, the real asset owners that are on the front lines of this movement. They're deploying that today. So, we're very bullish from a timing perspective. And I think that the return on investment, the return on, that innovation has really started to bear fruit and become much and much more obvious. From an investments perspective, we really do think it needs to be sequential, right? You need to get the infrastructure layers right, the data processes, the security, the connectivity, the orchestration, before you can start moving up the stack to the sexier sort of analytics layers. And we're very excited. We're excited about how companies are now harnessing, especially the power of that developer community, to make edge operations even more embedded in new products, new services, and overall sort of aligning to accelerate the deployment of edge resources and the growth of the analytics industry that's sort of backing all that up.
You guys might chuckle about this, but Edge has kind of been around for 20 plus years.
Yeah.
Rob, you might remember the days of what we used to call at Microsoft branch computing, which is essentially private VPN pipes to a major data center, but out in a subsidiary somewhere. That's the early days of Edge, arguably. Juan, just to kind of follow on that thought that you had, Gartner recently in a research memo indicated that about 50% or more of enterprise data will actually be created, processed, transformed, and used outside of the real traditional data centers and even in the cloud as well. So what you're highlighting is spot on. I think it's those data insights that enterprises are going to need to make near split-second decisions on their operations going forward. On that note, I'd love to get your perspective, assuming we've done the right work and made the right investments in the infrastructure side and orchestration and such, how important is for you to look at investing in super big data sets and folks who are sort of innovating in that world? Or are the data models and the services like the Snowflakes of the world today in place, are those good enough? I'd love to get your opinion on that.
Yeah, that's a great question. I think, so my perspective on this is, no, they're not. It's not that they're not good enough. It's just that they're not sharp enough maybe for the task at hand.
Right.
We fundamentally believe that you can't just take the IT stack, right, what works for cloud or what works for enterprise, and stick it out in the middle of the field. Think about that field, right? It's that remote oil well in the middle of Houston or wherever in Texas. It is real sort of physical, hardened. It's a difficult environment, and you have much more volume, much more velocity, and much more variety of data that's being ingested all of the time. That's the reason really that Edge is necessary, right? It's that you can't afford these round trips to the cloud for a bunch of different reasons. And so, the Edge operations themselves are fundamentally different from the cloud operations. Not to say that they're better or worse or more or less complicated. They're just different, right?
Yeah.
And so our point of view at Energize is that we really need sort of an OT specific or an edge specialty sort of toolkit, right, to be able to do a lot of those things, to be able to parse through data, to be able to structure it, to be able to have more focus on something as simple as time series data, right? If you think about those operations, those industrial operations, it's all time series data in a way that many cloud infrastructure isn't. Right. And so, how can we use the right tools that will align with those use cases directly rather than sort of as an offshoot of what they were really intended for? So, we see a lot of really interesting companies being born to address those needs from an edge specific use case. And, they're probably going to be pulled along by a lot of those, the cloud applications. So, it really kind of, the edge is a place where both come together. It's the physical and the digital really meeting, but it needs its own set of sharp tools for the job.
I couldn't agree with you more, Rob. When we were chatting earlier this week, I shared a point of view, and you had a really good perspective on it, and that was, in some circles, depending on who you're chatting with, it's sort of a foregone conclusion the hyperscalers will probably play a super active role in the edge. In my world, running the 5G lab, I see that as an opportunity for traditional CSPs, communication service providers, who have both spectrum and very large footprints. I think one of my partners, T-Mobile, operates I think it's 7,000 POPs around the United States. So you've got a really big footprint, but they don't necessarily have the inherent cloud services. I'd love to get have you share your perspectives on, is that really the case? Is a hyperscaler going to sort of walk into this world and it's theirs to lose, or is that the rules for that game not played out yet?
Yeah, it's a great question. It's $1 trillion question, frankly.
Yeah.
And if I had the answer, I'd be doing this, but probably not from an office. So I'll do my best though.
Okay.
As I look at it, I think the winners of Cloud Wars 1.0, they'll try to rejigger the map and not have Amazon be 50% share in 2.0 the edge, but they have the history of delivering infrastructure to a broad base of people. And they're going to try to move that out to the edge. That everyone's going to try to prevent that, or get, so you got the hardware vendors where hardware becomes much more valuable for some period of time because because you got this homogeneous, you got this very heterogeneous environment of hardware. That's one of the things that Cededa does really, really well is orchestrating all that. It's very, very hard to deal with. You've got Kubernetes, you've got VMs. It's a very complex, difficult environment on the edge. So the hardware vendors are going to make their attempt at it. You've got kind of the hypervisor vendors are going to make their attempt at it, and then you've got both. The advantage really is going to be, I think, to the independent software vendors like Cededa, because that's who ultimately wins in these things. Honestly, it's really rare to take $1 trillion TAM and then immediately port over. That's who everyone initially thinks is going to win. It's actually who you don't expect whose architecture is born for that solution versus having to backhaul all the cloud stuff. So the good news is for vendors like Cededa, I think those are going to be the winners. Those type of vendors. I think I'd love to see. I'm a romantic somewhat when it comes to finance, at least as well, and like the idea of the comeback kid with the carriers. I just haven't seen them crush execution on taking technology and rolling it out. They've got the infrastructure. They've got fantastic footprint, and maybe someone does it, but that is not who I would put my money on it as if I had to make a bet for the edge.
Microsoft, Rob, when I was there for almost 14 years, we had sort of said who's going to take an online book retailer seriously for cloud services, and we were wrong. So there's hope. There's hope.
I like it. There's hope.
I see that much hope. Hey, Juan, going back to your earlier comments, I really liked what you said around the investment thesis, really investing in sort of the base layers and kind of going up. Hypothetical question for you. Let's just say you found in your due diligence, you found a born in the cloud ISV that was designed and built for the edge, where their applications not only work great in public cloud and private cloud, but really optimized for some of the use case areas that you chatted with. Do you feel like the investment community is there to make investments in companies like that, or is it too early?
Yeah, I'm a little bit nuanced, right? Because this is all we see. This is all we do. We're specialists in and of ourselves.
Right.
And so Energize is very thesis led and very research oriented. And part of what sets us apart as an investment institution is we like to be close to these problems. We like to find about them first. We like to, find where the budget is growing, maybe before the rest of the investment community catches on. So I guess I'll shoot myself in the foot here saying, I think that those use cases are becoming more obvious, and there are more people that are looking where we are looking. We've seen big investment firms, Insight, Scale, Index, a couple others that have sort of placed their bets on analytics infrastructure and the application layer with a more industrial bent. So I do think that the overall investment community is starting to be interested again. I think that the peak hype, I guess, for edge really was 2008, 2019, when it was sort of the panacea that was going to solve everything. And then because some of those pieces were missing, a lot of those projects failed. But I think the investment community is coming back. We see, honestly, more importantly than the investment community, we see real budget is there. And so we see that the customer community has real budget allocated to some of these software deployments in a way that really wasn't available in 2019. We've gone from the innovation department to the real business units that are deploying. And I think that more than anything, at least for an investor like us, that is sort of the wave of the flag. This market is ready and the technology is really set for scale, versus, who else is looking.
Yeah, agreed. Question for both of you, and this might be slightly controversial, but hey, why not? Let's just have the discussion, right? There are moves being made across the board in the infrastructure play, right? So we have hardware providers. Dell's a great partner of ours that's done a lot of work in edge computing and is coming up with more and more solutions in that space. You've got some great work that's in investments being made in Kubernetes for broad distributions and the slices thereof. So there's a lot of that happening. The hyperscalers have come out with their own instantiations of edge, right? With Outpost AWS, Azure Stack Edge over at Microsoft, and I think some variant of Anthos over at Google. For firms like Zedata, what sets them apart to be different from those plays?
Yep, I'm happy to start. So I think the difference is, if you think about it just from their perspective, you've got a base business that's doing really well,
yeah,
but it's mature or maturing. And so you want to extend into this hot new growth market, but your kind of 1.0 when you approach it architecturally is preserve the base, right? Don't mess up the goodness that we have. That is by its definition, the architecture, everything you're building, whether it's really about your community you're interested in, you're setting your own, it could be just lowering your TAM to, I just want to take these existing customers and make sure that as the edge comes, we've got something responsive, as opposed to the other way, which it is coming from, which is like, how do I design a solution that's going to be helpful, the adoption of the broad-based edge? So I'd say actually the TAM address, and then the orientation of do no harm to the backhaul traffic is always a massive limitation, and ultimately what constrains these folks and their different approaches usually.
Yeah, I would add to that. I think that all of these other incumbents, like you said, Rob, have sort of their own vested interests elsewhere. And one thing that's really important for the edge is this concept of agnosticity, right? You have to be hardware agnostic. You have to be cloud agnostic. You have to be really analytics agnostic. You have to be a little bit of everything, play kind of the game with multiple providers and really enable the industry to make choices that if you're coming from either one of those angles, it's sort of against your best interests to make, right?
Yeah.
I think one of the most interesting things about the edge as we see it is that it's sort of that convening ground where cloud meets telecom, meets hardware, meets analytics, and each of those different players really doesn't have what it takes to fill that middle ground. And so we think that there needs to be an independent layer, a Switzerland, if you will, that can kind of play nice with everybody, I guess, and enable people to make really different choices about their businesses and about their digital infrastructure, their digital backbone. And I think that's where companies like Zedata, really play well. I think the open architecture is an important component of differentiation here as well.
Yeah.
And more, I'd say there's benefits to scale, right? Some of the biggest names in edge deployment are picking this solution. It's really Zedata.
Yeah.
And so I think that that's going to continue to compound.
Excellent. Wonderful. We have a question from the audience, Dan Fieldhusen, that's asking the following question, which is, how do VCs view industry investments with such high physical constraints where their return is not as easily converted in time, cost, and scalability as a digital investment?
That's a great question.
Thank
and
you,
one
Dan.
that I struggle with still. So at Energize, we actually like to focus on that software layer for primarily physical applications, right? So think about energy, construction, manufacturing. These are industries that require real machinery. But we think that the software layer actually is what helps empower and enable those to move faster, to be more efficient, to be to be more sustainable. I think as it relates to edge investments, a lot of companies out there have needed to maybe or wanted to merge both physical, the hardware, and the software. I think in large part because they've really needed to. They've needed to have it as a way to drive distribution, right? It's hard to be a software-only solution for a problem that is primarily physical, right? And so I think while we as investors and I think venture capitalists in general love the scalability and margin potential and ability for fast feedback cycles that you can have when you're making software rather than designing hardware, I think that there's always going to be the need for some hardware component to these industries, right? And that maybe drags things down from a margin or from a pace of growth perspective. But I think what makes it worth it is that if you get it right, sky's the limit, right?
Yeah.
It's sort of the early, VC system from 20, 30, 40 years ago, maybe even before cloud was really ubiquitous. It's huge payouts at the end if you're able to get it that, sort of make the risk more palatable.
Yep. Rob, did you have any? Thank you, Juan. Rob, any thoughts on that?
No, I think this is more a question for Juan. He's the investor, so I think that I'll stay quiet on this one.
Okay. I had a question for both of you, and we'll move on to just the investment climate here in a moment. But let's just assume in the utopian way that all enterprises are now edge enabled. There's a vibrant edge ecosystem, all that fun stuff. As a guy that's grown up in the enterprise IT world for 23 years, where you're used to flying blind, i.e., you don't really have access to much data or automation or any of that stuff, it's a fundamentally different way for enterprises to operate. If that utopian world were to play out, are enterprises ready for it? Or will they be sort of an information overload and not know what to do with all this new data, perhaps automation, other fun stuff?
I think yes. So I think I hope I think it'll play out, but I think everyone's overwhelmed. I think there's a muddled version of it, but a founder once told me where there's confusion, there's profit. I think there's another version of it where there's something, there's margin, but I think it's massively overwhelming, the task at hand, and it'll happen in fits and spurts, and it's going to have. So I kind of look at this bubble we just went through as if you go back 20 years ago, we had the internet bubble, which was connecting consumers to the internet. And then this software bubble was kind of connecting enterprises to the internet, really. It was. So I look at this next one as connecting everybody at the edge to the internet. I mean, it's going to be huge, but it's going to have a bubble that will outstrip, will certainly be on the par with the internet bubble and the software bubble. The cool thing is each bubble has more real businesses, just maybe some valuation that people get excited about, fueled a lot by monetary policy, by the way. But anyway, hopefully we don't have that this next time. But this is going to get huge to produce this. There's going to be bets made and things will go back and forth. But the overall scale of this is just going to be absolutely massive. There's a lot of confusion. I don't think as I made a reference to hardware earlier, making hardware cool again. At least for a minute, having a vertically integrated solution for some of these edge use cases is going to be very important where the hardware and software is embedded together. Everyone's gotten very far away from that. And Zendesk does a great job just focusing on the software, but that's going to be really hard to do unless you're kind of, you are the kind of Switzerland level player as you do this initially. Then you'll get the specialization. So there'll be fits and starts to all of this stuff for decades, frankly. I think it's going to be a massive opportunities take a long time to play out. And I think this is one that, software took 20 years, to play out. And I think you're looking at something similar now starting in the edge.
Great perspective, Juan.
I would also add that cloud is still in pretty early days. If you look at, there's this great analytic, I think it was, it might've been Gartner that put it out. It was percentage of revenue spent on IT across different verticals. And, for the tech industry, it's, I don't know, let's say it's 15% or something like this of revenue spent on IT. For utilities, it's like 4% of revenue spent on the digital questions that we're tackling today. Right. And that's mostly cloud. And so, we think that number one, the cloud, war, whatever you want to call it, is still in very early innings. And so that means that, any extension of that is still in early innings as well. But if we take the utopian sort of, okay, yes, great, that's all played out. Are people ready for it? I agree with you. I don't think we're ready for it now. I don't think, we're ready for cloud even now. I think that there's still a lot of catching up that we're doing in industrial operations. And I think that that's a really exciting, sort of problem set, because that means that there's a lot of education, a lot of, still imaginative new companies that can be formed to help people along on that journey. If you think about, how much cloud deployment is really services enabled, that's a pretty big number. Right. I think that edge will probably be similar. And then the last point that I'll make about this is, you can have, edge is so much about the data. It's about the data that's flowing through, about how can you parse through it to make, more informed decisions with better analytics that are sort of empowered by those operations. It's also super noisy, right? And so how can we as an industry make the edge not just, robust and scalable and all these other things, but valuable in that it doesn't just amplify the noise, right?
Yeah.
And I think that that's where, a lot of really interesting companies will be born, be able to take the, sea of data out from an industrial operation and boil it down to the 3 or 4 most important pieces that'll actually impact, business operations.
Fantastic. Well, let's shift gears, friends. Thank you. I've learned a lot. I thought I knew a lot, but I've learned a lot. So I appreciate you sharing your insights. Let's kind of shift over to sort of the investment climate generally, of which, Edge is a big part of that focus. The news that broke last week with SVB, and we're a proud customer of SVB ourselves. That was sort of unfortunate. It's playing out still, but it did put a spotlight just on the venture, the venture space generally. One, I'd love to get, your perspective from an investment standpoint of like, kind of where is the climate today? And did the SVB news from last week into this week really change trajectory, or was it sort of a long time coming? I'd love to get your perspective on that.
Yeah, that's a good question, Jim. I'll say a couple things. One, like you, we were also and still are, committed to this ecosystem, and I think SVB has been a fantastic partner for decades. To a lot of us here, to startups, to entrepreneurs, to investors, to LPs, right? And I think that they will continue to be, and we certainly want them to pull through. So that's number one. I think that there's been, and Bob, you could talk a little bit about rates and their impact on risk on and risk off. But we have been in a broadly risk on mode, really, for a long time. I think that we've had a couple of speed bumps along the way, things that have maybe shaken the tree to see, are we going to shift directions, right? I'll take you back to COVID, right? When COVID hit, that was supposed to be the end of the world. And really for at least digital companies, it wasn't the case, right? If anything, there was a lot of investment that got pulled forward. And we saw actually a lot of resilience in accelerating digital infrastructure, which is sort of what we do, right? Then we've had different shocks around interest rates, and I think this is the latest of sort of a sequence of shocks that have had a couple of I think impacts. One, does that sort of shake your faith in where the market is today in the near term? I think a little bit of a sort of re-rating in general is healthy. Does it shake our faith in where things are going in the long run? Honestly, not. I think that we see the future as more digital, as more connected, and we see these solutions as more valuable 5 or 10 years from now than they are today. Can I prognosticate on 5 weeks from now? No, but we're in the business of long-term games with long-term companies.
I agree. Rob, did you have any thoughts you wanted to share?
So yeah, I mean, just reflecting the same thing, maybe just a few other data points to I'm kind of a macro thesis guy. So U.S. economy is about $20 to $25 trillion a year of GDP, and in COVID it contracted about $1 trillion, which is about 5%. And the U.S. government put $5 trillion into a $1 trillion hole. The Fed liquidity went from $4 trillion to $9 trillion. That $4 trillion of the $20 trillion GDP is 20% of GDP. Which means if a mint costs $1, but in 2020 it costs $1.20 once that all rolls through, plus or minus. So that is an enormous amount of money, right? It's 20% of GDP rolling through the economy. That caused, the first place it went to properly was real estate and companies. Great companies. What are the best companies on earth today? The next gen, unbelievable companies that are going to transform, where you can make 10 extra money. Right? That's where it flowed to. So the issue, what the Fed has done is use the only tool really at its disposal, but it's not really designed to, that money's out there and crush on interest rates. And unfortunately, SVB was kind of the first casualty of that. That was unintended. The market has been on the hunt. It's caused a lot of dislocation. The Fed's doing a lot of great stuff. The federal government's doing a lot of great stuff right now. It just announced another thing with a rescue for a significant bank among other banks. So hopefully restoring confidence to the markets. But the issue is, as the Fed is rapidly, the fastest rate rise in history, drying up that pool of 20% of GDP, you've already had, 70% of it burn off through inflation, but you've got some more, and they've got this very strict policy. The problem is investors have the struggle. They got all the macro theses are there. Everything we've talked about at Edge is completely true, completely there. What's the right valuation? Last year in the housing market, I mentioned housing and equities. Housing had the fewest transactions since 2014 because there's a disconnect between buyers and sellers. Buyers are saying my interest rate's so high, I can't buy. You have to lower your price. Nobody wants to do a trade. That's similar in VC backed world right now, where you've got this. You had things priced properly for $5 trillion of excess liquidity. Now it's drying up, and we're trying to find each other, right, where the right place is to continue the journey together. That meeting will take place. I'm not going to predict when. I being a good banker, I'll say what, but not when, or at what price. But it will take place, okay, sometime in the next year, okay, and then things will progress from there, and there'll be a bunch of trades that happen from there. So there's a long way to say. Right now, there's a lot of confusion, but as I said earlier, where there's confusion, there's profit. There's going to be a lot of. I think people may not love investments they made in 2021, but they're going to love investments, I think, that they're able to make now going forward. So it just has to, the confidence has to be restored, and public markets are in a similar situation as well. So I think that I love 2024, and I hope it gets started earlier rather than later. And I hope this latest kind of crisis in confidence helps be a catalyst for things to kind of bottom out, and people can, kind of restore to some sanity here and start kind of finding a middle ground where we can get transactions done and move forward. But I'm super bullish on the overall trends, and technology epicenter, no better place in the world to be than here, and it reflects in the strength of the US dollar. It's just a matter of time, and whatever stages need to happen before we can have a meeting.
Yeah, I agree. The last thing that I'll add to this is, I think in those sort of risk on boom cycles, investments go, kind of anywhere where people think there's going to be a good return, regardless of whether the company itself is going to be valuable in the long term or not. One of the things that makes us the most excited about, Edge in general, and I think, Sedita in particular, is that these are real problems. These are real applications. These are real positive ROE calculations that, customers are making. It's not out in the ether. It's not some imaginary, thing. The benefit of I guess maybe the benefit and the costs of Edge is that it is physical, that there is something tied to it. There is something that's tangible, and it does impact business operations today and in the future.
Juan, thank you for that. You touched on something, and if you don't mind, I'd love to dig in just one layer deeper. For all intents and purposes, SVB had and still has a strong balance sheet, right? What was unfortunate was a draw on cash was just regular operations with not as much inflow of deposits normally one would see through investments that venture firms were making into startups that would counterbalance that draw on cash. And so arguably firms were holding on to cash, startups were continuing to draw more of their deposits. And then you had this lopsidedness that led to, what happened last week. In 2021, there was a pretty significant push of capital into startups that was sort of downsided in 2022. And I was reading as early as this morning that 2023 could see a continued slowdown in investments, and there could be more down rounds than there are up rounds this year. From where you're sitting, I very much see 2023 as still maybe very much a correction year, and as Rob mentioned, 24 kind of being a growth year. Do you see the same from your standpoint? I'd love for you to share an investor's perspective with those who are listening today to kind of get your driver's perspective on where things are going.
Yeah, for sure. I mean, look, I think averages are unfair, right? But let's just talk about it. I do think that on average, a lot of the investments that were made in those sort of peak of the market years were maybe chasing more momentum than fundamentals. I think that's probably a concise way to say it. And I think that, like Rob said, as the tide starts to go out, the market starts to maybe parse through that noise a little bit more clearly, and is able to better separate the signal from the noise, and is able to see, hey, okay, well, now that the tide's out, what do we have underneath? And I do think that is a correction that that is sort of shown in the amount of capital that's flowing into the space, the number of companies that get funded, the size of the rounds, the number of, all the number of layoffs, the number of all of these different things sort of come together to show the data points to the story. But the story is, if we were ahead of the fundamentals, we need to kind of get back to the fundamentals. And for some companies, that's going to be grow steady and keep things on. And for some companies, it's going to be, oh my gosh, we need to pivot hard and we need to, cut a lot of, maybe cut a lot of people and move in a new direction. It's going to be very, very nuanced. That's why I don't like, sort of the averages. I do think that in general, 2023 feels a little bit more like 2018 or 2019 than 2021 or 2022. And I do agree with you, Rob, that 2024 is going to be, much more fertile, I guess, if you're thinking about it that way from a multiple entry point perspective. On the other side, right, like we have a portfolio of companies that have been invested for some time, and so you want those companies to not exit where multiples are low. And so as someone that is deploying capital into new investments, you love to see a more sober potential multiple valuation. On the other is companies are starting to find their way out to exits. I think that's where quality remains, right? If you think about that fundamental and you've got good quality and great markets and good teams and good technology, you will still get a premium, right? You will still get be able to earn a solid return on investment that is driven, once again, it's driven more by fundamentals than by fund flows per se.
Super great point. Rob, I wanted to touch on your 2024 comments. Some of the big tech players, Google, Facebook, Microsoft, Intel, the list goes on, have been sort of tightening up their operating capital, in some cases even instigating some layoffs. And largely, if you read the narrative, it's really around enterprise spend is tightening and such. To your comments around the growth aspects of 2024, what are you seeing the enterprise buyer at a macro level really doing?
Yeah, it's great question. Another big one. So a couple things. One is going back to that kind of macro. So you got $5 trillion of excess stimulus, $1 trillion, so $4 trillion excess of the 5. There was actually a study I just read. It was as of August, and it said that consumers in America have, if you pretended there was no COVID and you took 2019 and just projected out the normal savings rate, that rate in August of 2022, they had 1.7 trillion more than that rate would suggest of savings, and that eventually it's kind of embedded inflation as they spend it. It causes inflation. That's why inflation is very sticky once you put out that kind of money. So that's good on the consumer side. On the enterprise side, though, right? I think we have to go back and look at what is enterprise spending going to be. So if you look at cybersecurity, where I spend a huge amount of time, the general market, grows, $80 billion market grows around 10% for enterprise. The public companies grow around 20%, about double the rate of the market. Pretty good, really hard to do. I mean, you're taking share at double the rate of market growth, really impressive. During COVID, in 2019, we went from 20% the public companies it is out there to 30%, a 50% increase in growth. But that was growth without any check on accountability around profitability, generally speaking. So you had an artificial good. Now we have all the Q3 data, which it dipped to and most of the Q4 data at this point, it dipped to 28%. Now that's coming down into the mid-20s. But even if it goes all the way down to 20% growth, right, it's actually right in line with 2018, 2019, at which point the public markets, depending on your growth trajectory, were between 25 and 100% if you're hyper-growth in software, above where it was in 2018, 2019. So even if you get all the way back down to 20, we've got this fear, you're in your level with 18, 19 spending. So I'm using 18, 19 spending as a proxy because I think that's a pretty good proxy. So I think we're in the part of coming down there. The deflationary period, though, feels pretty shocking because you're literally cutting growth by a third, right?
Yeah.
Mm-hmm.
And the reality is it's become so unpredictable. And then because of the Fed raising and all the implications, it goes from, okay, we need 13 signatures to there's tool rationalization and we need to have fewer things to, the latest thing. We've been through RIFs 1.0. Unfortunately, I think we're going to go through RIFs 2.0 right now again. And as that happens, you can be on the 1-inch line, ready to punch in the touchdown. and then the person you've been working with for a year and a half gets riffed and you're way back on the 50. So all of those things, fewer licenses, all these things, that all that pressure as that growth decelerates down to that 20% level feels pretty heavy. So I think we're right in the thrust of it right now. I'm hoping it bottoms this year from an enterprise spend perspective, but I don't think I know it's not going to be in Q1. I used to say I was cautiously optimistic it's Q2, and now I'm super best case scenario optimistic it bottoms in Q2. I'm actually probably realistically hoping Q3 or Q4 is the bottom, and then we get going again. I think if the Fed winds up having broken enough of the economy here, it gets comfortable enough on because inflation is kind of done. Like I said, it's going to burn off. What's not done is it's unclear if it just continues at 3 to 4% instead of 2%. That's a big, I don't know. But getting down to 3-4% is going to happen by the end of this year. So if they get comfortable with that and start cutting rates, that could give confidence to start building up. Once they start that process, it takes a quarter or two to start seeing it in enterprise sales. So the best case scenario is Fed pivot in, whatever the next, couple of, May, June, kind of July, and then by the end of the year, you're going again. But I think it's a really rough re-rate year for overall growth. If you talk to the public companies, they don't know what growth is going to come out this year.
Yeah.
And so I think it's, again, that reframing of getting back to that 18, 19 sustainable level. And then we have a market and enterprise spend. Security has been more resilient than others. But even it's showing some real slowdown this quarter, and it's accelerating. And then general enterprise stuff is really, really slowing down pretty dramatically right now. So unfortunately, it's just a rough year, and there's going to be another round of layoffs, and that becomes fewer seats. So there's a little bit of a compounding effect here that's going to put pressure for pivot, is my prediction. But it's going to be a rough. It's going to be a rough enterprise sales year.
Well, yeah, I agree. I think just maybe one last comment here. I think it helps separate what's discretionary versus non-discretionary spending for companies.
Right? Absolutely. Well, we got insights today, gentlemen, that you can't really read about online. Thank you again for imparting all of your expertise and knowledge on us. For those who are listening today, thank you for joining us. We're going to take a quick break, and then the next session will begin here at 1:45, which is about 3 minutes from now. It's a keynote session with Sanjay Upal, who is the SVP and GM, a service provider and edge business unit at VMware, alongside Saeed Uzel, who's the CEO of Zdata. You can find a link to the session within the agenda on the general sessions section. So thank you all for attending today, and enjoy the rest of the event. And special thank you, Juan and Robert, for a great panel conversation. Really enjoyed it. You all have a great rest of your day. Thank you again.
Thanks, Jim. Thanks, everybody.
Thank you.
Thank you.